All right, hello and welcome everyone to the final event of our 2024 Quarterly Education Series. We appreciate you all joining us today. We're going to be discussing often underestimated but mighty aspects of your financial plan. My name is Kevin Skiffington, and I'm the manager of the Wealth and Participant Education teams at Strategic Retirement Partners. I'm pleased to introduce my colleagues and our presenters this afternoon, Brandon Lawrence and Rich Lombard. Brandon, Rich, and I are part of the SRP Wealth Team, which is an extension of our retirement plan business. Our team focuses on financial planning and investment management solutions for individuals, families, and couples. We recognize that your workplace retirement plan is just one piece of your financial life, and Rich and Brandon specialize in bringing together all pieces of your financial life into one succinct plan that is specific to your values, priorities, and needs. Few quick notes before Brandon and Rich get started. This session is being recorded, and a link of the recording will be sent to all registrants next week via email. Everyone's lines are muted, but we do welcome your questions. Please scan this QR code, which will be at the bottom left side of each slide, to open the Q&A feature and to submit your questions. At the end of the presentation, we'll do our best to answer them all. We've broken today's topic into 4 pillars. The first is building, where we were talking about foundational steps of any financial plan, starting with identifying your values and priorities, creating a budget, and setting aside an emergency fund. The next pillar is managing what you already have. We'll talk about some basic investment concepts, understanding taxes, saving for education, and planning for retirement. Third, we'll talk about preserving. We'll cover insurance protection and different types of insurance that you may need. Our last pillar is about transitioning, where we'll look at some of the basics of estate planning. As we continue today, think about these questions. Number 1, do you know where you stand financially? Most people either don't know or have a very vague idea. The next important question to ask after that is, have you ever done any personal financial planning? It's important to do this for every financial aspect of your life, which we'll get you started on today. Now that you're considering these questions, I'm going to pass it over to Rich to get into what financial planning looks like.
Thanks, Kevin. As Kevin mentioned and brought up those questions, just consider them as we go through our slideshow. Now we're going to start off by talking about pillar number 1, which is building. In other words, building wealth. Really, when it comes to personal financial planning, an important thing to consider, or 3 important things to consider, are a plan that aligns with your priorities and your values, and that it's designed in such a way to take action, because a plan isn't worth anything unless you take action. Slide, please. So when it comes to your values and priorities, we're all unique in this sense. There are a number of priorities that we can have, many we share, but many we differ in as well. For instance, one of the things you might value is things that you do for the near term, such as taking care of high credit card debt or paying off car loans, things like that. You may also need to plan for college if you have children. Very important expense and very high expense these days. You're also going to want to plan for maybe buying a house, paying off that house, those types of things. And you're also going to want to plan for something that we all enjoy doing, which is our fun. We're working hard, we're trying to put this money away, and hopefully we get to enjoy that in retirement. So save some money for fun as well. Another question I'd like you guys to all consider is, what is most important to you and your financial life? Because that's really going to help with what those values and priorities are. If you haven't thought about it right now, it's a great time to start, no matter if you're young or older. And where does it all start? It's a great question. It really starts with budgeting, because you have to know where you are to really know, where you want to go, and to really paint that picture of retirement. So when it comes to budgeting, really the first step is assessing what your income is. I know this kind of sounds like a simple concept, right? It starts with your paycheck, of course. And then it goes into other aspects, which some of us may or may not have. In other words, you may have some rental income from a rental property. or several rental properties for that matter. You may be fortunate to have government benefits like a pension. Those don't really exist as much in the private sector anymore, but they were very prevalent for a long time. And now 401ks have really replaced it. But if you're a government employee, you probably have a pension, or if you were in the military. So that's an important part of really a fixed income, a stable income through retirement. You're also going to consider things like the interest on your investments. How much are they gaining each year? And then finally, you're going to want to look at your investment income. Investment vehicles like bonds will kick off interest or dividend paying stocks. So all those come into that calculation of your income. Then the next step is really, it's a vital step, and one that I find that people don't have as much of a handle on as they should, and that's what their expenses are. If you haven't done really a thorough assessment of what your expenses are, you really have to do that before coming up with your budget, because we have to know what's coming in terms of cash flow and what's going out. So, when it comes to expenses, you're going to have fixed expenses like your, say, rent or mortgage, things like that. But then you're also going to have more discretionary expenses. Things like, buying a new car and financing that, or again, back to the fun, maybe dining out, then traveling, something most of us enjoy doing. Those are all going to be things to build into your budget. So once you have a handle on your income and your expenses, you subtract your expenses from your income. And that should hopefully, for most of us, leave a surplus. If it doesn't leave a surplus, it's time to reassess really what those expenses are and where we could maybe cut some of them out so that we do have a surplus. But if we do find that we have a surplus, what do we do with that surplus? Other than just having fun, really a more important thing to do is have an emergency fund. If the last several years have taught us anything, is that emergencies happen. We had COVID, we have all kinds of climate related disasters happening now in terms of hurricanes. These are things that we can't really predict. So it's important for us to have a fund established to account for these in case there is an interruption with that income flow that we have. And it's vital, as the slide says, an emergency fund is the foundation of any successful financial plan. So if you're working or have dual income in your household, we recommend saving 6 months so that you can cover 6 months of your expenses. If you're retired, you have to be even more aggressive about that, and you're going to want to have 12 months saved and put aside because you're on a fixed income, and you're really going to need to account for that because you don't have as much coming in through your income. So also what's really important is where you keep that emergency fund. You might be tempted to just say, I'm going to leave it in my checking account and just that's where I'll draw it from, or maybe I'll just leave it in an investment account and I'll draw it from there. Well, the problem with the investment account is you may have to sell investments at the worst possible moment to deal with that emergency, and really at a tax time that might not be beneficial. So one of the things you can consider doing is keeping that emergency fund in a high yield savings account. There are many choices now for that. And the really beautiful thing about that is it's entirely liquid. You can get at it right away. You don't have to sell anything. It's right there at your fingertips. So really consider where you're putting that emergency fund.
That's great advice there, Rich. And, when we start to look at that, building a solid foundation is so important. Having those dollars set aside in case, life throws a wild card at you, you can navigate and be proactive with that. But once you establish all those bases, it's about pillar number 2. It's about managing your assets and building those assets in the investment accounts. So before I dive into specific investments, I want to ask you some questions here. The first one would be, how would you describe your overall risk tolerance? Would you say you're very aggressive, maybe ultra conservative, maybe somewhere around middle of the road? But most of the time we get the answer of, I'm not quite sure. I'm not quite sure what my risk tolerance is. So that leads into the next question. Do your current investments align with your risk tolerance and your goals and your priorities? Do they? Well, in most cases, that's where a financial planning will start to develop is, that purpose for the money here. But as we start to build out a portfolio, there's really some key factors when we're looking at building a diversified portfolio and having an evolving portfolio to really manage the markets and everything else that life throws at us. Now, some of the portfolios that you have will have one, two, or maybe all three of the components, and it may just be because where you're at in your overall investing cycle. So with having these three components in mind, growth is the first one that we look at. And this is the investments that provide over time that you buy, you hold, and at some point in time, you hope to sell them for a profit, more highly appreciating assets, the more risk on assets. In the income side, this is where, as you get closer to retirement, people are starting to want some of that income, maybe some interest, maybe from a savings account, maybe it's from interest-bearing bonds, or something of that nature, but it's going to provide you a current source of income, monthly, quarterly, maybe semi-annually. And the last part would be the stability factor. This is the portion of the portfolio that doesn't move with the overall markets. It's that really more that cash position, that stability in the portfolio, that protection. At the end of the day, you have enough set aside so you're not staying up at night worrying about are my markets conservative enough for the income needs that I have here. So we know that we can't control markets. The markets are going to go up, down, sideways, every which other direction, but over time they do go up. So what we have in our court that we can control here, since we can't control markets, what can we control? And it's all about having a plan. If you have a plan with your investments that are aligned with your goals, your values, and your priorities, it will really start to hone in on what type of risk that you need to take. You'll also start to look at dollar cost averaging into your 401k account, boosting your overall average returns, putting in money every week, every 2 weeks, things like that. Having a diversified approach, different stocks, different bonds. But one of the bigger components that isn't talked about, front and center is your asset placement. We talk a lot about diversification from investments, but what about your different tax types? So when we look at different tax types of investments that you can have, most of you will be familiar with IRAs and 401ks on the right-hand side there, that bucket. Some of you may have a Roth 401k or maybe Roth IRAs in the center, and maybe taxable accounts such as a savings account, or in this case, a brokerage account that has investments. And we're looking at diversity of your investments, different stocks and bonds. You're going to have different tax treatments that are going to be better in different buckets of money. And keeping this very high level here, when we look at highly appreciating securities or investments, these are generally stocks where you're going to buy them, hold on to them for a period of time, and then sell them. So when we have a Roth IRA, Rich will talk a little bit more about taxes, but when we have an investment in a Roth IRA, they grow income tax deferred and come out income tax free. So no matter if you sold an investment and you made $1 million on it, it's coming out income tax free. So that's a very valuable bucket of money to have for tax planning purposes. The next best bucket we look at in terms of, generally speaking, is taxable accounts because they have capital gain rates that are more favorable than ordinary income rates that you would have in your IRAs and 401ks. So when we look at putting, stocks are highly appreciating assets in these two buckets over here, and then we put more of our fixed income in our IRAs and 401k. They're a lower appreciating asset, meaning they're going to be a slower growth, but they're producing current income, and that can be a higher tax rate if it was in, say, a taxable account. So the overall goal here is that when we look at the efficiencies of your investments, it's keeping a linear tax picture, and then also considering that at some point in time, at age 73, and it is going up, that required minimum distributions, the government will require you to take out money. And that, in a lot of cases, is more than what most people need. So in a combination of all these, if you have a diversified tax approach, it's going to be able to keep more money in your pocket versus paying Uncle Sam.
All right, so let's talk about some income tax considerations that are very important to all of us. So one that I get a lot as a 401k educator is, should I contribute to pre-tax versus Roth? And this also holds true for, opening an IRA, traditional IRA, which is pre-tax, or an after-tax Roth. Both depend kind of on your individual situation, but the differences between the two are that with your pre-tax contributions, be it to your 401k or an IRA, those are going to be taxed later. Those are tax deferred. So when you take distributions out, say in retirement, whatever your tax rate is at that given time is what you're going to pay, on those distributions. The other thing that the pre-tax side of the equation does is it lowers your taxable income. It comes right off of the top of your paycheck, and your taxes are calculated after that comes out. So if you're a high earner, if you're somebody that's filing jointly, you may want to contribute more to that pre-tax side because that'll lower your taxable burden right now. On the other hand, if you are, say, younger or in a situation where you're thinking about paying tax now to get it out of the way, then consider Roth. I don't know about everyone on this call, but I happen to think that taxes really go one direction, and that's usually up. So Brandon mentioned required minimum distributions. You have to start taking those in your 70s as it currently stands, and you'll pay tax on that if you have pre-tax funds at whatever the rate is at that point. However, with Roth, since you're paying the taxes now, you're going to pay it at today's rates, which should be lower. So if your tax situation is one that you're in a lower tax bracket now, perfect time to consider, doing Roth contributions, and then later considering things like Roth conversions. Another important tax concern when it comes to retirement savings is, ordinary income versus capital gains. Brandon touched on it with the bucketed approach to allocation for your assets. Some of your assets are going to be taxed at your ordinary income level. Though again, those distributions you take from your retirement accounts, those are going to be taxed at your ordinary income tax level. In your other accounts, like your brokerage accounts, you're going to be taxed only on the capital gains. So in some senses, it makes sense to put more money into those because you're only going to pay at the 15 or 20%, depending on your income, tax rate for those types of accounts. So again, that just makes that asset allocation bucketing so much more of a really effective approach, as Brandon mentioned. The next thing we're going to talk about, and we're going to take a little bit of a deeper dive here, is understanding how the marginal tax rates work. So I know there's a lot of confusion about these tax brackets, but let's see if we can clear some of that up. So the first bracket, and these are 2024's rates, is the 0% tax bracket. That's a tax bracket I think most of us would really love to be in, but very few of us really are in that group rather. So, but that group, you're just talking about your standard deduction that we all get. And then everything from 0 to 11,600 is taxed at 10%. And then everything from that 11,600 up to the 47,150 is taxed at 12%. But it's only from that $11,000 to the 47,000 that's taxed at that 12%. So you'll notice this big jump here too, from 12 to 24%. This is where actually a lot of us fall, and that big jump can lead to some creative tax planning within that tax bracket. But then when you run up to the 24% bracket, I'm going to use that as an example of how the marginal tax brackets work. When it comes to that, you're paying 24% on anything from $100,000 up to $191,950. So what that means is your effective tax rate, or the actual tax you're paying, is somewhere around 16%. You're not paying 24% on the whole amount. So that's really important when you think about things, like Roth conversions or, tax planning with your accountant, is that you're not paying 24% on all of it. You're only paying those higher amounts on the dollars that go into that bucket. So just hopefully that clears, up that a little bit more. Just know that you're not paying the actual rate you're seeing on a federal level. You're paying less than that because you're paying in a marginal tax system. So some final considerations in retirement. I often encourage my clients to have a picture of retirement in their mind. What kind of retirement do you want? Again, if you haven't thought about it at this point, now is a great time to start doing it, regardless of how old you are. It can change over time. A picture of retirement is a living, breathing thing. If you have a significant other, please include them in this discussion as well. Talk about where you want to be. What kind of retirement? What do you want to do? Do you want to travel? Are you going to downsize? Are you going to move to a new state? Again, that might go back into the tax considerations that we talked about. The next, really important thing to consider when you're thinking about that picture is, when do you want to retire? You may want to consider things like Social Security in that, discussion, because for most of us, we'll take Social Security at 67 years old. So if you retire at, say, 62 and don't take your Social Security, how are you going to finance those years? Again, that's where the financial planning really comes into play to help you bridge, that gap there, to make sure you have the funds you need to meet your obligations. But very important, consider when you want to retire. Do you want to work to full retirement age? Do you want to work into your 70s? It's really changed a lot over time. Used to be people got to their full retirement age and it was like turning off a light switch. We're not going to work anymore. Now people more soft retire. They really keep doing the things they like doing. They might consult their former company, or they might go work at Home Depot just to keep busy. And that leads me to the last point. How long will retirement last? Well, none of us has a crystal ball for that, right? We don't know how long we're going to last, but we have to plan, that we're going to live for a long time, because we don't want this money to run out. And people are living longer today. So it's important to have a plan that shows you what that cash flow looks like through all of those retirement years, to help you, enjoy your own retirement, but also to help you pass along money to your heirs, or charities, if that's something that's of interest to you. So again, the importance of a plan can't be understated in terms of making sure that the money lasts through retirement and, helps you really live that retirement that you're dreaming about. But seriously, come up with that dream and then put it into action with a plan.
Absolutely. That's always one of the big questions, is how long is that retirement? And we continue to live longer and longer, and healthier lifestyles as we continue. And, as part of this conversation is, if you're, really on that retirement doorstep, or even starting out, preserving and protecting yourself to get to that point is super important. And a lot of times when we're talking about preserving and protecting, it's about risk management and passing on some of that risk to various insurance providers. And we're here to be an advocate and to really help plan and make a plan for you. It's not about owning insurance. It's about having a plan that fits your overall financial situation. Now, with insurance, there's going to be a bunch of different types I want to cover today. There's going to be insurance that you actually physically need, and some insurance that you probably haven't thought about, or maybe it's not the right time for you here. So when I talk about insurance that you need, that's going to be insurance that's maybe government mandated by a financial institution, such as health insurance. Kind of need to have health insurance, otherwise there are some penalties for that. Auto insurance. The states require you to carry liability insurance if you're driving on the roads. If you have a loan on that, you're going to need to have full coverage. Similar with your house. You'll have protection on your house in case it burns down or somebody breaks in, so on and so forth. So those are some of the insurances that you need. Now, what about the insurances that you may not have thought about? Well, these are the protections for you as a person, like life insurance, disability insurance, protecting your ability to continue to earn income over many, many years. And then as you get closer to retirement, maybe that transitions to more of a long-term care need. But I'll start off with life insurance here. And with life insurance, it is first, foremost, and always life insurance. And when we look at it, there's generally out there two different types if we generalize them. We have term insurance and we have whole life insurance. And the main difference is term insurance you're going to purchase for an X amount of years, commonly 20 or 30 years. You're going to buy a death benefit of maybe $250,000, maybe it's $1 million, maybe it's more than that. And it's going to be in place for that period of time. So if you continue to pay your premiums, you're going to have that coverage in place for you and your family. The big thing with term insurance, it's to protect your ability to earn income and to make sure the roof stays above your family, food is on the table, and life continues if God chooses it's your day tomorrow. So that's with term insurance. As needs start to get more complex, or looking for coverage that lasts out to maybe age 95 or age 121 for the millennial generation like myself, you start looking at whole life. And this is something that you would purchase and you pay in, and it's going to accumulate a cash value. You'll either receive a dividend from a mutual company, maybe it's invested in the markets, but you will be credited there, and it's meant to be for your entire life. A common situation for whole life is maybe you're a business owner and you expect to have, estate taxes, or you want to leave a legacy at the end of the day, that's where whole life would come into play. Again, just having a plan in place to make sure you have proper protection is the most important. Along with that, I mentioned protecting your human working capital, and that's with disability insurance. And this sits really near and dear to my heart because my dad was actually injured on the job at age 42. And because of disability insurance, we've continued to have a roof over our head, food on the table, and now, able to go to college. But with disability insurance, it's if you are injured on or off the job and you cannot work. Some of your employers will provide group coverage. Maybe it's short-term disability, maybe it's long-term group coverage, but understanding what that group coverage means to you. Most commonly, a 60% is pretty common out there for coverages, and you can elect to pay the tax on that premium, so the benefit you would receive is income tax-free to you. Another important consideration when looking at disability insurance is if the policy is your own occupation. And I'm going to use a really extreme example here. Say you're an anesthesiologist, you're in the operating room, really looking over people while they're under the knife there, and you can no longer do that job because you can't work your hands or whatever that condition may be, but you can go and work at a fast food restaurant. That's a pretty big income discrepancy there where disability insurance would make up for that. But there's also some other things to consider. If you're no longer working and injured, you're probably going to have higher medical bills. You're probably not going to be saving for retirement, and maybe you have student loans if you're in a professional career that required a lot of schooling. So there are ways that you can structure your disability insurance to, replace your paycheck and cover for all the extras that you would be saving in life. So it's very near and dear to me, and it's something to really take consideration too. But as you really transition into your early 50s, mid 50s and on, your working capital or that ability to earn income is starting to decrease. And hopefully at this point, you've had your retirement nest egg building, it's growing, and it's going to be where it needs to be to produce that good amount of retirement income for you to do whatever you want and achieve all those values and priorities. But when we start talking about insurance, the conversation generally transitions from life insurance and disability into what happens if I need care. And most commonly here, most people are self-insuring on the left-hand side of the screen, but it's all about having a plan. Like I mentioned before, having a plan and understanding the pros and cons to each of the decisions that you make. So with long-term care insurance, self-insuring is an option. It's playing the odds that you will not need care. You're putting the 100% of the risk on yourself, on your pocketbook, on your investments, and you're saying that it's going to be the least expensive if I do not need care. But on the opposite, if it's the most expensive, you could be spending quite a bit of money, millions of dollars. I have a family member that went through this, a couple $1 million in care expenses because they didn't have some type of coverage. On the opposite, traditional long-term care insurance, this is what most people have that are in care facilities now or purchased 20 years ago. It's similar to like a homeowner's policy. If you do not utilize it, you lose the premiums that you paid in. And what's happening now is that every single year, the policyholders are receiving premium increases that are substantial. So the industry, the government has come together to say we need some sort of a solution to more of a hybrid type of product to where if I don't need care, I don't want to necessarily pay in a bunch of money. I still want to reap the benefits for the next generation. So it's really about paying premiums and more of a lump sum type of scenario where you're moving money from your right hand and putting it into your left hand or left pocket, and it's still an asset. But if you ever need care, what happens is there's a rider that will provide a benefit for you. And if you exceed the death benefit amount, which would be the case, there is nothing to pass on to the next generation or your beneficiaries because you would have used the whole policy. But there's way to make a plan to whether you want to fully insure 100% or maybe only half of it. Having a plan is what fits your scenario is what's most important here. And with long-term care, that's part of the transition of retirement. But transition, I'm going to talk more of estate planning here, which is relevant to everybody on the call. And with estate planning, long-term care is part of all this, but there's really 4 different. Next slide there, Kevin. There's 4 different objectives and goals when we look at estate planning. And at the end of the day, number 1 is about efficient distribution, getting the money into the hands of the people that you want it to be. So when we look at efficient distribution, there's a couple ways that you can go about this. Beneficiaries and registrations on accounts will supersede any wills and trusts that you do have in place. Transfer on death deeds. This would be like on a property, on a house. A transfer on death would be on a brokerage account. And then a payable on death election would be on your bank account. So if you have any of these elections or a jointly registered account, those assets will flow directly on those elections and avoiding a probate, which is number 2. We want to avoid probate at all costs because it's money that potentially the government can get and other people that you may not want to receive those funds. So with the probate, a will and last testament will be the document that will guide the probate courts to your last wishes. A trust is specific examples that's written out and control from the grave of how you want your assets to be distributed at, say, a given age, after a life accomplishment, or a wedding. However you'd like to control your money will avoid that probate within a trust. And again, registrations and beneficiaries will as well. Number 3, this isn't relevant to everybody, but minimizing estate taxes. I'm in Minnesota. We have an estate tax. There's also a federal estate tax. But if you have a sizable portfolio or a lot of real estate, a business, there are ways to start gifting now, placing money in trusts or irrevocable life insurance trusts to better off your end of life tax picture. And then at the end of the day, this applies to everybody here. Planning for incapacity. Anybody over the age of 18, you really need to start thinking about a power of attorney or healthcare directive. Actually, both of them. The power of attorney will allow somebody that you elect to step in and sign their name for you if you cannot make those decisions. Similar with your healthcare directive, that will dictate if you want a ventilator, if you want life support, cremated versus buried. All of that information will be included in there. And I say it's important for everybody over the age of 18 to have these, is that at the time of need, if you do not have these, we have to go to the petition to the courts, and then they will elect the people for you. So it's just easier to have them in place now and get those, in a safe place where you can find them. And then we also touched on long-term care planning, but it can be a huge portion of your overall estate plan of how much money is left over to pass on and structuring that. If you have a sizable estate, it may be worth looking at, a way to plan for that to preserve more money from going to nursing homes and or the state that you live in. So when we put this all together here, we fully recognize there's different life stages all in this call, from you're just starting off, maybe you're just in the workforce, you're just getting started your 401k, you're building your emergency account, or you're the complete opposite. You're in decumulation, maybe you're in retirement or on the doorsteps of it. We've built out our advocacy program for our guidance on wealth based on this. So we understand that everybody is going to have different scenarios, and we're here to be your advocate. And how we go about this is through a program we call Asset Map. And we find it's a really easy way to build conversations, help you understand what you have going on in your life, and put it on one piece of paper. Maybe you don't have a bunch of investments or accounts or insurances. Maybe you want to start to look at, what do I need to start thinking about? We can help with that, showing what some of your peers are doing. But at the end of the day, we're able to provide more guidance and specific recommendations for your scenarios of, here's what retirement looks like. Here's what we can do in terms of investment management to better your overall tax picture. I need to look at maybe stacking a disability policy on top of my group coverage. What does that mean? These are all the items that we can help by getting you organized, and we can start taking action from there. So we'll put up this QR code here at the end. If you scan this is a great way to get in contact with Rich, myself, or any one of our certified financial planners on our wealth team. We're here to be advocates and turn that tool of 401k money into something more powerful that you can really accomplish whatever it is that you want in life, and be proactive with it as life throws different cards at you here.
Awesome. Thank you, Brandon. Thank you, Rich. Now we're going to move on to the Q&A portion of our presentation today. Pull up the questions here. All right, so question number 1 for you guys. When or why do I need to talk to a certified financial planner?
Well, I think there are several times in your life where that makes some sense. I mean, I think, the most common time for that would be, you're starting to think about retirement, you're getting into your, kind of later 50s, and you've been investing all along, but what you're starting to realize is that, a portfolio is not a plan. So, your portfolio, if that's all you have and no plan, you're just going to draw off that portfolio, and you might do it too quickly. So once you're getting closer to retirement, and I'm not saying like, the day before, the week before, I'm saying, years before, really start laying it out as you start having significant assets, you start having children, you really want to come up with a plan that's going to, make sure your money is allocated correctly. Those buckets that Brandon was talking about. You're going to want to make sure that college is financed. You're going to want to make sure you understand what that cash flow looks like year in and year out throughout retirement. Once you come up with that picture that I talked about, of when you want to retire. So that's really going to dictate it. But really, now's a good time to start financial planning because, it's never really too early to have at least a basic plan in place, but you could just build on that and it becomes, more of a comprehensive plan as you get closer to retirement.
Awesome. Thank you, Rich. One person asked, could you repeat where to park emergency fund money?
So one thing I mentioned with emergency fund money is a high yield savings account. There are a lot of options out there now. One that I recommend a lot to my clients, it's called a Marcus account, MACURS, MARCURS. So that's by Goldman Sachs, and it's a high yield savings account. It's got an app that goes right on your phone, or you could access the website. You can move money back and forth through your accounts. And currently I think it's somewhere in, the 4.5% range in terms of what it's paying in terms of interest. So it generally does outpace, just your standard checking or savings account.
And the nice part with Marcus too is that they have payable on death elections. So if you don't have a jointly registered bank account, you can actually place that beneficiary designation on there. So it's not all that common with all the banks out there.
Next question, when will we get a copy of the presentation? That's going to be sent out to you all next week, early next week, likely 1 week from today. Next question, how do you balance retirement savings and saving for a home? What is an appropriate savings rate?
Yeah, great question. So when we look at just generalizing to get to that healthy retirement between your contributions and your employers, if you're saving 15 to 20% right off the get-go when you started, you're going to have a very good retirement there. So I'd say, that happy medium, it's always going to come down to budgets and figuring out kind of what are the priorities there. But as a rule of thumb, if they're at that 15 to 20% for retirement, that's where you should be.
Awesome. And I see a couple raised hands. A reminder, you can submit questions using the QR code. I will bring that up in a moment here. I'm going to fire off one more question to these guys. Where would I get long-term care insurance? Number one. And at number two, what age should I start long-term care insurance?
Yeah, great question. So the kind of the golden period for long-term care insurance is when you're still healthy. That's the biggest thing. With any of this insurance, you still have to be healthy. So my biggest thing is too early is like in your late 40s, but anywhere from like 50 to your early 60s is a time you want to start looking at long-term care coverage because you're going to have a better idea of what retirement income may look like. And then what is the trade-off and opportunity to have some sort of long-term care coverage? Here at SRP, I'm one of our resident insurance experts. I grew up in insurance. My whole family's been in insurance. It's something that we can help with and help plan. It's not just about purchasing a policy, but having a plan in place that complements your retirement income, your taxes, your estate plan. It all comes into place for that long-term care policy. And that's something that we can absolutely help you out with and give you the either which side of the equation for you.
Awesome. And one more reminder, that is the QR code to submit your questions. I am going to take that down so I can see our current questions. Give me a moment here. So related to insurance, one person said, this is a more broad question. What type of insurance makes sense? Seems like there are too many. How do we know which choices to make?
Mm-hmm. Yeah, there's always going to be a concept called insurance poor, where you can have all these insurances, but not have enough to live or enough to save. Insurance coverages are a very personal choice, and I recommend if you're looking at, life insurance or disability, long-term care, having a thorough conversation with not a salesperson, but more of a planner to understand everything that's going on, to give that recommendation of maybe you don't need disability or life insurance because you have it through your employer, or whatever the case may be, but you'll have that truthful, honest advice acting in your best interest versus being sold a policy.
Next question. How do I know if I'm financially on track? Where can I learn more about stocks, bonds, ETFs, mutual funds, and other options for diversifying my portfolio? This can feel overwhelming with all the information out there, which I totally agree with, by the way. Where do
Yeah.
I start?
I agree with that too. I mean, and I do this for a living. So, it's a great question. And I mean, really where you're going to get an idea of that is working with a financial planner, a fiduciary advisor. That's important to go to a fiduciary advisor and really have them assess, based on information you're going to give them, in terms of, where you are. I mean, Brandon showed asset map there, and that's a great starting point for coming up with a plan as well. So it really starts with, I would say, interviewing advisors, finding one that you're comfortable with, and really, hashing out what that, going through that budget exercise first, and then, figuring out what your surplus is, what you want to do with that, what makes sense, and really what your individual needs are. So yeah, it starts with really, working with an advisor and finding an advisor that you really connect with. That's where I would say it starts.
When is the ideal time to do a Roth conversion? And is it better to pay the conversion tax out of pocket or from the distribution amount?
Well, oftentimes when it comes to Roth conversions, I advise my clients to wait until after they retire because generally speaking, their income level drops at that point. But when it comes to getting money into Roth, you want to pay as little taxes as possible to get it over into Roth. So, for lower income earners, that they can consider it if they have pre-tax funds now. Some plans offer in-plan conversions to do, but generally speaking, my clients, I work with them later on to convert systematically their funds over to Roth, not all at once. You don't want to take your huge chunk of retirement savings and convert it all at once because you're going to pay a lot of taxes all at once. Generally, if you look at where you are in your tax bracket year by year, you can determine if you have an excess amount of room in your tax bracket. So you just convert over that amount so you stay in the tax bracket that you're in. So, again, important to have a strategy about it, but generally I start more aggressively doing that with my clients once they have retired.
Yeah, and with that being said, having a Roth conversion strategy before you make decisions on Social Security and your pensions as well is very crucial because that opens up the tax brackets as well. So it's more of a bigger picture planning situation like Rich had mentioned. There's other scenarios like if you're a business owner, have some carry forward losses or losses other places, it may open up some Roth conversion opportunity. So I will just mention this. We know what the tax codes are today. They will be changing in 2025 to whatever they may be. But we just understand that tax rates are going up and a Roth conversions are a huge part of your overall financial plan to keep your tax picture somewhat linear without having a bunch of spikes over that long period of time there.
Excellent. At what point in the transition phase that you spoke of is it valuable to speak with a tax advisor?
I would say if you do not have a tax advisor at any point throughout your working careers, you should find a good CPA. If you do not understand the tax codes, TurboTax, all the ones that do them yourself, they're good programs, but the expertise advice from a certified public accountant is invaluable. So highly suggest at any point, just go and find somebody that you get along with great and has the credibility and expertise.
Totally agree. One person asked about annuities. How do annuities generally perform as an investment vehicle? What percentage is a good target for annuities?
We might have to take that one offline. So annuities from fixed to variable rates, payouts, investments are all determined based on specific products. So whoever asked that, they could take it offline. I'm happy to do so.
Yeah, definitely. And there's a few questions similar when we're talking about specifics to an individual situation. Those are what we'd ask you to book a consultation for. It is a free 30-minute consultation with one of these guys. So I do see a few questions coming in with some more specifics to individual situations. So if you don't hear yours answered, we'll put up the QR code at the end here one more time and email it to you as well. One more question that came in. If I already have 6 months saved for emergencies, where's the first place I should start putting additional money for investments?
Well, I mean, again, it does somewhat depend on what your tax situation is, but if it's after tax money, you're probably going to have to, consider putting it into a brokerage account to grow that money, or You might have an option on, putting some, pre-tax money into like an HSA or something like that in terms of, tax favorable types of accounts. You may contribute to a Roth, things like that. There's really, a lot of different options you have for those next dollars. And you want to look at it both from a, where am I going to get some interest on that, to also where is it going to be the most tax efficient place to put it as well.
Yep. At the same time, don't overcomplicate it. Saving money, if you're saving it somewhere, it's going to be there for later on. That's the most important. So if you're not sure, talk to us. Maybe you put it in your 401k, but as long as you're saving it, whatever is easiest, just to put it away, you're not going to regret it 10 years, 15 years, or 30 years down the line.
Yeah, and we're getting a number of questions with a theme of basically, where do I start? It's kind of the recurring theme of what we had discussed previously, or what the question from earlier. So that is, I would recommend rewatching the recording of this, number one. And if it's still confusing to you, I would say book some time with one of these guys to go through your specific situation, because there's not a one size fits all approach, unfortunately. But let's see what else we have here.
The best part, guys, is that you've already started, right? Because you watched this webinar. So you've already begun the journey, and the next step, as Kevin said, is to really book a consultation.
Awesome. Real quick, last question I have here could both of you say your credentials?
Yeah.
Sure. So I've been doing planning for a long time. I have my Series 66. I have my insurance licenses. I'm also a certified rollover specialist. So, and I've been in, working in finance for about 25 years.
Yeah, I got into the industry. I was actually still in college. That was 13 years ago now. So specifically do a lot with 401k plans, more specifically personal wealth management, a lot of income taxation. That's really my background. I have a retirement income certified planner designation, non-qualified plan advisor, certified plan advisor, and accredited investment fiduciary. So a bunch of alphabet soup behind my name.
Wonderful. And we are having one more question trickle in. This will be our last question since we're at time. And we did not discuss 529 plans today. It says on excess 529 plans, is the Roth conversion by the beneficiary or by the account owner?
Should be for the beneficiary.
Awesome. Thank you, guys. Well, like I mentioned, we're at time. We will send a recording out this next week, along with a link to book an appointment. I know for those personal consultations, I will put up the QR code again here if anyone wants to book. But we really appreciate you all joining us, taking time out of your day to be with us. We will have continue these educational webinars in 2025, so keep an eye out for your email for dates and updates. But once again, appreciate you being here, and we wish you all a wonderful holiday season.